Welcome back to Thinking Outside the House. This is the podcast that explores the world of real estate beyond owning your first home. My name is Ed Plucher. I'm your host, and today we're doing what we call Base Hit. I'm actually going to begin a series on the steps I would take to begin investing. And as with all podcasts of this type, none of this is considered particular personal financial advice, investing advice, anything like that. It's just education, but there are certainly professionals out there who can help you with every step of the way. Now, the steps I have to getting involved in investing are going to vary from what other podcasters and gurus and experts will tell you. I'm not saying necessarily this is the best way, but I sat down to think about it, and I was like, well, what do I think is the best path forward to getting involved in investing? And, that's something I can uniquely bring. Maybe it'll speak to you. Maybe it's something you can bounce around in your head and develop your own order or own sequence for getting involved in investing. And certainly there'll be some who disagree with a step here or there, but this is pretty well the general course toward buying your first investment. So the first step is really to understand why real estate. You do have other options when it comes to investing. There's obviously the stock market. You can get involved in buying or investing in a business, which is stock market-ish, or you can do that more directly. You can have your money in a CD or bank account, which I don't know why. You can also do, peer-to-peer lending. You could do cryptocurrency. Lots of options there if you're just trying to put money in and get more money out. Each with their pros and cons. So why, among all those options, why would you take the same dollars and put them in real estate? So the first step, the first reason why I think real estate is pretty much the top notch, the bread and butter of your investing strategy, or should be, is, first of all, not everyone starts with this, by the way. First of all, it's durable. And what that means is if you've got land, not much changes with the land, right? The land is always there. It survives, it endures over time. Certainly on a human scale, we're not talking geological, like, 4.5 billion years of the Earth's age, but more like, is that same parcel of land going to be there in 100 years? Yes, it will. 200 years? Yes, it will. So certainly in your investing timeline of 10, 20, 30, 40 years, that piece of land is going to stay there and be meaningfully the same in the vast majority of cases. That actually would include, with a caveat, of course, any improvements, meaning did you build a house on it? Did you put a building on it? And for the most part, obviously there's maintenance involved. Things do degrade over time. Things do need to be repaired and replaced over time. But if you do basic maintenance, which is just kind of like the main basic line of maintaining a property, then even the house itself, the building itself, is going to be rather durable compared to most other things. I am involved in cryptocurrency, and I see how volatile it is. And at this point, I would say, I don't know if its durability is all that strong, but it certainly doesn't compare to real estate, right? Cryptocurrency can go away completely, and real estate will still maintain its existence and its benefits. All right, enough of that. Two is it's finite. So ultimately, it's scarce. There's only so much of it. The old joke goes, they're not making any more of it. And what that means, in combination with the first one means that real estate, the value of it essentially never goes to zero. You might find, like, a toxic waste site or something like that, where we're leaving out the exceptions. Talking about things that you would find in your neighborhood, around your city, in all likelihood, that property is going to be worth more than zero. And there's stocks and bonds and other things that, well, not bonds, but stocks that could definitely go to zero. There's cryptocurrencies that definitely go to zero. And they're just utterly worthless at that point. Real estate won't do that to you. The thing with the finite, then, the scarcity, is that it generally appreciates. And the reason is demand over time, because more and more people will be alive and wanting real estate will increase. And so the demand will cause the price to increase, and you've got that going for you. Something not a lot of people think about. They do think about it. They should think about the fixed interest rate, which we'll come to in a second, because that kind of plays with the inflation hedge. But they may not think about the fact that it's right under your nose. You can buy real estate with leverage. So you can go in and buy an asset for $200,000, $1 million, and you don't need $1 million. You need about $200,000 to buy $1 million, or $250,000 to buy a house. of $200,000. You don't need $200,000. You can have as low as $7,000, but you might have $40,000 for a 20% down payment, particularly if it was an investment property. And so in that case, you are with a minimal investment relative to the size of the asset, you are controlling quite a lot of value in that asset. So that's not to be overlooked. That actually segues into the fact that not only can you leverage to buy the asset, but then if it's an investment property, you're having somebody else pay down your obligation on that leverage. Of course, that means that you get a loan, you have a tenant, the tenant pays you rent, the rent covers the mortgage. And so that principal amount on your mortgage is going to go down, down, down over time. And you essentially didn't have to do anything, didn't have to put any money in to do that in a wise and a smart investment. And there's, as far as I know, I haven't encountered it yet. There's not an investment I'm aware of that has that dynamic at play where you can borrow money to buy it, and then you can literally have somebody else paying down your debt obligation while you continue to control and enjoy the benefits of the asset. If I'm wrong, let me know. Send me an email or comment. So swinging back to the inflation part. First of all, you can buy it on a fixed interest rate, which is the vast majority of mortgages made. Can be typical mortgages made. And the great thing about that is, for the most part, except for taxes going up, right? That payment is going to be steady over time. So other expenses, maintenance costs may go up, materials may go up, things like that. Taxes will go up. We know that. Insurance may or may not go up, but for the most part, the rest of it, that principal and interest is going to stay flat for you for the rest of the life of that loan. And what's great about that is anything fixed in a fixed payment over 30 years is going to get easier and easier to pay just automatically. It's as simple as saying, if you went back 30 years to the early 90s and you took out a mortgage on a house, and just call it, $500 or something like that, that may have seemed like a lot at the time, especially if you're younger, it's your first investment, first house. Those monthly payments at first seem like quite a lot, but as you continue and inflation works to your benefit, everything else goes up. Your wages tend to go up, not always, unfortunately, but in general they do. And that initial payment, 500 or whatever it is, 1,000, whatever it is, becomes less and less a part of your total income, your total financial picture. So it starts to look more like, say, a car payment than it did a house payment originally. So the benefit there, obviously, is that if you could sort of grin and bear it now, and you don't necessarily have to suffer through the first few years. You could certainly buy the right property and not have to suffer like that. But even if you bought a total stinker and you had to fix it up and you couldn't get it rented right away and it took a lot of time. I've got a property like that now, actually, not quite that bad, but it's having a few troubles. And I am simply reminded of my first property, which was similar. Had a hard time keeping it rented, had some big maintenance costs right away. But at this point, it's stabilized, meaning that there's not a ton of maintenance it needs right now. The tenants are long-term tenants who are paying on time, and the rent has gone up over time. So not only will your own income go up, but then the rent will go up over time as well. Again, just naturally part of inflation. It's not you being a cruel person and making people pay more and more money. There's just actually more and more money available in the economy as a whole. And so that works to your advantage too. So that fixed payment begins to feel relatively lower and lower and lower over time, even though it's the same amount of money. And your income then, as a result, is going to go up and up and up. The final thing, which is not as glorious, but it's still there, is actually, I should say the second and final thing is it's tax advantaged. So there's a couple things you could do with that. One is the depreciation, right? You take the building, and the IRS lets you act on paper like the property is going down and down and down in value over the course of 27 and a half years. So you divide the value that you bought it at by 27 and a half, and each year for 27 and a half years, you take that amount of money off as a loss on paper. Now, you didn't lose that money. Nobody came and took it from your bank account. But when the IRS looks at your income, they're going to subtract that loss and then tax the new lower amount. And that's the way you save on taxes a little bit. There are other things as well. The classic one, obviously, is the 1031 exchange. I actually haven't done this yet, but it's certainly something I'm planning on in the future, hoping it stays in effect. But what that means is that you can take your smaller properties and sell them, and then there's hopefully usually a gain on that, right? Because you bought lower and you sold higher because time passed, inflation happened, appreciation happened, and what was I saying? And so you take that amount of money, and rather than have it go back to your bank account, then the IRS is going to tax it. Then you're going to end up with half of it or something, or 3/4 of it. You can parlay that, transfer it to a new building. You could set up a new, bigger building you want to buy. It has to be of, I believe, equal or greater value. And you could just make that purchase, and the funds transfer to that new building tax-free. So think about what that means. You can actually move to a building with more tenants who are paying you possibly more money, or not even more, but collectively more. And so you can actually increase your profits with the same money without having to put necessarily any new money in it, and without being taxed on that money you did take out. So that's a huge advantage there if you know how to work it. And again, that's something a lot of real estate investors do and take advantage of. The final thing also is sort of a given, or is hopefully a given, but it's cash flow. So you can work through all of these elements that I just described, and have the tenant paying rent, and their rent is covering your mortgage, and it's covering expenses, it's covering taxes, insurance. And you can actually, if the market rate bears it, you can actually charge them more than that amount that you just need to just get by. And you should, because you should have some savings built up for capital expenses, things like that you can't anticipate coming up, or you can, but you don't know when. But there's the idea is you're going to buy a building that somebody's going to rent, a unit or the whole house or whatever it is. They're going to pay you a fair amount based on the market value of, renting a unit like that. And that amount, if you work the numbers right and you purchase right, is going to be higher than you actually need to pay all your expenses. And now you've got, voila, profit. And that's, or as known in real estate investing, cash flow. And that's the final benefit of the whole process. You obviously want to be in cash flow. You want to have positive cash flow on a building. There are some investors who will buy with flat cash flow or even negative cash flow. I've heard of this. I've never done it, not on purpose. But what they're banking on obviously is the appreciation and the rents going up and things like that. They're saying, I'll take a loss these first couple of years, might even want the loss the first couple of years, and then start to benefit from the gains in the following years. But you certainly can and have been able to buy properties that cash flow right away, cash flow a pretty healthy amount. And what you do with that is obviously your own prerogative. But the goal there would be, reducing your reliance on your full-time job, for example, or saving up for, family expenses, your own trips, your own retirement, building up a portfolio of properties that essentially is your retirement plan for once you decide to retire. If you're in real estate, you probably don't have a 401k. I don't want one. I'd much rather have this great investment that, once I put a nice chunk into it, it's sort of doing all of these financial gains for me without me having to think too much about it. Obviously, there's a management level to it, but it's not. It's the returns on it are outsized compared to the effort you have to put into it. So possibly a little longer than I was hoping to go, but let me see where we're at here. Okay, good. So that's it for why is real estate a good investment. I think I covered just about everything. If you have any questions, or if you have anything that you think I missed or along those lines, feel free to reach out. You can find me on Facebook. I post these every day, every week on Facebook. You can reach me at ed@theplutragroup.com. We are a real estate company as well, and we can help you with that, buying and selling investment properties, as well as residences and things like that. Next week, we will talk about setting a goal, and we'll go right through the process of buying your first investment property. Hope this is helpful. Thanks.